What if the greatest financial disaster of your lifetime didn't look like a disaster at all? What if it didn't come with exploding markets, screaming headlines, or collapsing banks, but instead arrived quietly in slow motion, as ordinary people gradually lost purchasing power, savings, ownership, opportunity, while a tiny fraction at the top accumulated wealth on a historic scale? And what if this wasn't an accident? Because today we explore a mystery hidden behind the curtains of global economics. A design so subtle, so elegantly disguised as normal, that most people never even realize they're inside it. This is the story of the quiet collapse, a financial mechanism engineered over decades. One that steadily transfers wealth upward, generation, while convincing the majority that everything is simply the way things are. But the question is, how did this system emerge? Who built it? Most importantly, can it ever be reversed? Welcome to a journey through shadowed boardrooms, historic turning points, deregulated markets, engineered recessions, and policy decisions that shaped the modern financial world. This is Finance TED Official, and today we peel back the layers. When the formula was first written to understand the quiet collapse, we must start where the foundations shifted. Not with cryptocurrency, not with the 2008 crisis, but decades earlier. The birth of the modern financial machine, 1944 to 1971, after World War II. Global powers gathered at Bretton Woods to design a system to stabilize the world economy. Currencies were linked to the US dollar, and the dollar was backed by gold. It was simple, predictable, hard to exploit. But as the American economy grew, military spending expanded, and global trade multiplied, something began to crack. There simply wasn't enough gold to support all the dollars being printed. The world's currencies were floating on promises that no longer matched physical reality. By 1971, President Richard Nixon took a step that silently re-engineered the future. He closed the gold window, ending the gold standard entirely. This single decision unlocked the ability for governments and central banks to create money without physical limitation. It was the moment the quiet collapse became mathematically possible. The power shift begins when money becomes unlimited. Those who control its creation gain an extraordinary advantage. Banks, corporations, central planners, asset owners, investors, the tools of wealth changed. No longer tied to gold, no longer restrained, currency became elastic. Those who could access it early became the winners. Meanwhile, ordinary workers still earned and saved dollars as though the system hadn't changed at all. The rules shifted. But the people didn't know. The rise, the wealth transfer engine activates once money creation became unlimited. One question remained: who gets the new money first? This is where the hidden mechanism, known in economic theory as the Cantillon effect, quietly began transferring wealth upward. The Cantillon effect in real life, when new money is printed or introduced into the system, it doesn't reach everyone equally or instantly. It enters first through banks, government programs, large corporations, investors, asset markets. These entities buy assets, stocks, real estate, commodities at cheaper prices before inflation fully spreads through the economy. Then by the time the average person feels inflation, everything is already more expensive. Wages lag, savings shrink, living costs rise. Meanwhile, asset owners profit from the inflation. The game is simple. Those at the top receive the new money first. Those at the bottom receive it last. The upward wealth transfer begins quietly. Deregulation, in the era of financialization from the 1980s onward, a new philosophy dominated. Let the markets run free. Banks merged. Corporations grew into giants. Derivatives multiplied. Debt became a product. Financialization, the process where the economy shifts from producing goods to producing financial instruments, exploded. Within 40 years, the financial sector's share of corporate profits tripled. CEO compensation rose 1,200%. Worker wages rose less than 15%. Asset prices skyrocketed. Home ownership became harder for every new generation. The quiet collapse gained acceleration. The debt explosion as wealth flowed upward. The bottom 90% turned to debt to maintain living standards. Household debt, student loans, credit cards, medical debt, personal loans, auto loans. Debt became the invisible bridge between stagnant wages and rising costs. But every bridge has a toll. and every toll collects upward. The breaking point. Crises that weren't accidents. Every financial collapse in modern history reveals the same pattern. The bottom falls. The top gets bailed out. Move chronologically. 1. The savings and loan crisis, late 1980s deregulation, allowed higher-risk lending. Banks collapsed. Taxpayers covered the losses. Executives walked away wealthy. 2. The dot-com bubble 1999 OS 2000 hyperinflated markets. Insiders cashed out. Retail investors lost billions. The wealthy bought assets at the bottom. 3. The 2008 global financial crisis. The greatest wealth transfer in modern history, at least until 2020. Banks caused the collapse and were rescued with trillions. Millions lost homes, jobs, and savings. The aftermath. Wall Street profits hit record highs. Home ownership among young people plunged. Private equity bought foreclosed homes in bulk. The quiet collapse was no longer subtle. It was industrialized. For the pandemic and the trillion-dollar expansion 2020 to 2021 under the cover of crisis, central banks injected unprecedented money into markets. But where did the money actually go? Not to small businesses, not to workers, not to communities. Over 70% of new money flowed into corporate bonds, stock buybacks, billionaire wealth real estate investment funds. The result? During a global crisis, the wealth of the world's richest individuals soared. Meanwhile, inflation ravaged purchasing power. Housing affordability hit a 40-year low. Wages struggled to keep up. This wasn't an accident. It was the system working exactly as designed. Fallout. The collapse you don't see. Some collapses are loud. This one is quiet. It happens slowly, invisibly, and mathematically. The disappearing middle class in the 1970s. The middle class represented over 60% of total wealth. Today, in many countries, it's below 40%. A structural erosion. 2. The illusion of choice. We are told, work harder, start a side hustle, invest what you can. But the ladder is pulled up while people are still climbing. Housing, healthcare, education, costs rise faster than wages can follow. The middle class becomes renters. Renters become debtors. Debtors become dependents. 3. The age of permanent inflation. Inflation is no longer a cycle, it's a feature, because inflation quietly taxes the bottom to lift the value of assets at the top. Every year, your money buys less, their assets buy more. The quiet collapse continues. Failed fixes. Why solutions never work? Governments claim they're trying to fix inequality. But here's the truth. Most solutions strengthen the system instead of weakening it. 1. Low interest rates sold as helping homeowners actually fuels asset bubbles and helps investors buy properties in bulk. 2. Stimulus programs, market liquidity increases. Most of it flows to corporations and wealthy asset holders. 3. Financial literacy campaigns useful. Yes. But teaching people to swim doesn't fix the tidal wave coming at them. For tax adjustments, loopholes remain. Corporate tax burdens fall. Wealth taxes rarely pass. 5. Regulation attempts watered down by lobbying. Loopholes appear instantly. The system is designed like a maze. Every path leads upward. It's not because of conspiracy, but because of incentives. Incentives shape outcomes. And our global incentive structure channels wealth toward those who already have it. Modern parallels, the pattern still repeats. Let's look at today, 2025. Does the quiet collapse continue? Absolutely. Shocking data points 2025. The top 1% owns more wealth than the bottom 90% combined. Billionaires gained more during global crises than in the decade before. Housing affordability is at its worst in modern recorded history. Corporate landlords are buying entire neighborhoods. The average worker's savings last less than 1 month without income. Financial asset stocks, real estate are concentrated in fewer hands than ever. The pattern is unmistakable. The new wealth extraction tools, algorithmic high-frequency trading, digital rent extraction, KI-powered financial markets, private equity expansion, subscription-based, everything monetization of basic needs, housing, health, education, data exploitation as a commodity, the upward flow continues. Faster, smarter, more automated. Here are 3 truths you must understand about the quiet collapse. 1. It is not a sudden event. It's a slow, engineered shift. But most people won't notice until they feel trapped. 2. The wealth transfer happens through everyday systems. Inflation, debt, housing, corporate consolidation, ordinary tools with extraordinary consequences. Asterisk, asterisk. It collapses quietly, while the top rises visibly. Asterisk, asterisk. The quiet collapse is not the end of society, but it is the end of the old middle-class dream. If this pattern continues, the future won't be defined by countries or borders, but by classes. A world divided not by geography, but by access. Access to assets, access to capital, access to opportunity, access to ownership. The quiet collapse is not just happening, it's accelerating. This is Finance TED Official, where we decode the systems shaping your financial future. If you want more deep investigations like this, hit subscribe, share this video, and let's expose the mechanics behind modern economics one layer at a time. Stay aware, stay informed, stay ahead.